Let's start with the one that most people are familiar with. The cash ISA limit is shrinking. So currently everyone can add £20,000 into a cash ISA to earn interest, and this will be completely tax-free. But as of 2027, this is being reduced to just £12,000. Now your overall limit is still £20,000, but only £12,000 can sit in a cash ISA. The other £8,000 must go into a stocks and shares ISA. Of course, if you're over 65, this doesn't affect you and you can still put £20,000 in a cash ISA. And one important point, this only affects new contributions. So if you already have a load of money sitting in a cash ISA, this doesn't affect you. This is just for making contributions in the following year. So the next big change that's coming is tax on savings. Now this is going up by 2 percentage points per rate band. So as you can see, the basic rate is going from 20 to 22, higher rate from 40 to 42, and additional from 45 to 47. Now, of course, this is savings interest you're earning outside of your ISA. So this will be things that people have a savings account within their local bank. And the starting rate for savings allowance is remaining the same. So let's look at an example of how this might affect you. So we see here we have savings for the interest this year. So this depends on the band that you're in. So if you're a basic rate, a higher rate, or an additional rate. Now we can look at the amount that we have and we look at how much tax we would be paying this year and how much tax would we be paying from the following year. So of course, if we increase this, let's say we have £5,000 in savings, how would this affect us? Well, if you're a basic rate band payer, you pay an extra £80, 90 for a higher rate and 100 for additional rate. We can change this and see how this would affect different people. And you get the idea that there is a slight increase here by 2% every year, depending on what rate band you're in. And of course, this whole spreadsheet that we'll be going through that I've built will be available in the link in the description. So the reason this is also quite a big deal is because they're reducing the amount you can have sitting in a cash ISA, and they're increasing how much they're charging for people who have savings accounts. So it's kind of a double hit for a lot of people. So let me know in the comments which one of these changes is going to affect you the most. And somebody that might actually usually put £20,000 into their cash ISA, this is how it might affect you in the following years. Now obviously you can put £8,000 less into a cash ISA and you might then move this into a savings account, and this is how it would affect you over the course of 5 years. Now it doesn't seem like it's that much per year, but obviously it starts to add up. But of course if you're only saving £12,000 anyway, this wouldn't affect you. Now the next change is for landlords. From 2027, rental income actually gets its own tax bands. And these also sit 2 points above the normal income tax. So if you're letting out your property, these are the bands that they're going to get taxed at. The mortgage interest rate relief will stay capped. Now of course this relates to England, Wales and Northern Ireland, and Scotland has separate rules. Now before anybody starts to panic, of course if you're just renting a room, if you're a small-time landlord, this probably won't affect you. You can still earn up to £1,000 of property income tax-free, and £7,500 if you're just renting out a room in your main residence. This is really to try and squeeze the bigger landlords who have multiple properties who are earning a lot of rental income. So again, we can look at how this might actually affect you. So if you're earning maybe £20,000 in rent, you can see how much extra you're going to start paying every year. And here we can start to notice a pattern. So tax on savings, dividends, rental income, everything seems to be rising. Now here's the big one if you're self-employed, and it's actually already started to be rolled out. Making tax digital. For anyone earning over $50,000, you might have already started to implement changes to your business. From April 2026, you'll have to submit digital tax returns. So what does this actually mean? Well, currently people will usually submit one self-assessment tax return every year, but this will require you to get a software that's approved by HMRC and submit 4 returns per year and submit an annual declaration. So if all of your combined income, self-employment income, rental income is going to be over $30,000 next year, you need to be prepared. Now this isn't necessarily more tax, but this is a lot more admin. And a lot of people have decided to go with an agent to pay them to do the tax returns for them. You can still do this yourself. If you go onto the government website, you'll see they have a lot of articles here on how you might be able to do this yourself. And you do just need to make sure that you have a compatible software, which I think is the big one for most people because a lot of people won't have this set up already. Now here's a big one that I've already made a video on, but I just wanted to cover it again to make sure that it's included in the changes upcoming. Your pension is going to be joining your taxable estate for inheritance tax. Now this is a huge change for a lot of people. Over the past many years and decades, a lot of people have been planning their estate around their pension because it was such a great tax loophole. It was really considered the most tax efficient way to pass down wealth to your future generations. Now we need to be clear as to who this actually affects. So as we know that everybody gets £325,000 of tax-free allowance for inheritance tax, and that raises to £500,000 if you have a property. So if your total taxable estate is still under £500,000, including your pension, that means that this doesn't actually affect you. But if you do have a substantial home and substantial savings and a pension, this is how it might affect. So let's say that the value of your whole estate, excluding your pension, so that could be your home, any current accounts you have, any investments you have, was £600,000, and you've managed to save up a £200,000 pension. And let's say you are leaving your home to your children. Well, your tax-free allowance is 500,000, so that will reduce that down. And we know that the inheritance tax is 40%. So using the old rules, your pension wouldn't be included. We'd just be looking at the £600,000 here, and it would be 40,000 of the remaining 100,000. But now that your pension is included, the inheritance tax from 2027 will jump from 40,000 to £120,000. And you can see here, if we start to raise this number, you'll see how it really starts to affect people. And that's why there's so much outrage here. A lot of people have been planning this for years and years and years. And for this to just switch like that overnight, or from next year, it really has a big impact, and people have to start thinking about how can they actually amend their financial plans for the future. Now, there are some very clear exemptions here. Anything passed to a husband, wife, silver partner is excluded from inheritance tax. And of course, anything that's going to a registered charity. And for those of you who have death in service lump sum payments, those are also excluded. Now, of course, the executors of your will are the ones that are going to have to sort this out, so make sure that you include this in your any financial plans. Now, I've also made a shorts video on this, and there's a lot of rumours going around and a lot of headlines that are trying to scare people. So I just want to be very clear on what's actually being proposed here. This is not law already. This is something that HMRC has proposed, and it's a tax on the cash sitting in uninvested investment ISAs. And not a tax on the cash, but a tax on savings being earned from that cash. Now, as we mentioned earlier, the cash ISA limit is going from 20,000 to 12,000. So people are trying to think about tax loopholes as to where that cash can sit. And a lot of people thought about moving that cash into stocks and shares ISAs. In platforms like Trading 212, you still earn interest on cash sitting and uninvested in those investment ISAs. So you can see here why HMRC is maybe thinking about trying to tax that, because it closes that loophole. But this would just be for money that is uninvested in these accounts. And there's no announcement, but I'm sure there would be some sort of grace period. It's not that as soon as you sell your investments, the next day it's being charged. We would assume maybe 1 to 3 months, but don't hold me to that. Now, don't make any huge financial plans based off of this. This is still proposed, so until we know more, I wouldn't make any changes. Now, here's the underlying problem that's secretly making everything worse. There's a freeze on personal allowance thresholds until 2031. So as your pay is going to increase with inflation, we would hope, you do get dragged into a higher tax rate band. And it's actually probably the quietest tax rise of the lot, because this will affect you for the next 5 years. And it's really the backdrop to everything else that we've covered. And I just want to go over this one small admin change for payroll teams. Benefits in kind are going to now be included in payroll. So it used to be at the end of the year, everyone would fill out a P11D. But now it's actually going to be month on month, and it's just included as part of the whole thing. But this maybe would affect your tax code and your payslip, so just something to be aware of. Hopefully you found this helpful. If you have, please consider subscribing, and I'll see you next time.